Hey everyone, welcome. Good to see you guys. Hope everyone had a good day. We had an interesting day for sure in the market where it was from the start very bullish and then we tapered off. It looked like we were going to chop sideways. And then in the last half hour, we really broke back below that EMA 8 and sold off into the close. Now, I gave some levels in the Telegram channel where I'm on the wrong, where I said, okay, 678 was the level, 680 grew throughout the day, but I was still at 678 in terms of the net exposure. I translated that into XSP and then I did a 0 DTE trade where we did a 681, 680 put, meaning that if it was below 680, then we realized the maximum profit. So I got in at 54, that would have been 46 of profit on 54 of risk, which is, I believe, around 85. Yeah, 85% profit. Unfortunately, because it was so strong and we stayed above that EMA 8 for so long, I said, oh, I'm just going to stop out of this. But then, of course, XSP closed below, just below 680, and the original levels were good. And unfortunately, I did send out that message. No, normally 0 DTE, I just hold it into close. I don't care because I'm prepared to take the full loss. But just goes to show no one's immune, right? I have a lot of people who potentially followed me into that trade, and I wanted to do right by them and just, hey, let's take some risk off the table, and it would have worked out. But that's the way it goes. You don't win every single time. Even if you're right, you don't win every single time. So I'll continue to give some 0 DT levels, 0 DT trades, and on net, we should be making a good amount of money. All right, let's see who we've got here. Hey, Spider Monkey, good to see you. Hey, Stacy. Ralph, 76 degrees. All right, that's about the same as over here. You guys are nice and warm over there. Hey, David. Hey, Tim. And hey, Maria. Thank you for bonus trades this week. Oh, you're very welcome. You're very, very welcome. Another bonus trade we had was that city. Okay, and it is continue to chop sideways. And if we look at the option strat on that one, I have a bunch of trades right now, but this is the bonus one. And you can see that it did float upwards. And so we're very comfortably inside of this profit zone. And if it keeps going up, doesn't matter. We'll make that 22% into next week. And if it hangs out right here, we potentially make 75 to 100%, or all the way up to 103, we would still make more than that 23%. So that trade is going very, very well. I'm very pleased about that one. Uh, yeah, just you can't win 100% of the time. That's correct. That's right. So we just learn. We learn. And so I learned that, hey, when I have other people following me into the trade, I'm not immune. When I'm by myself, it's perfectly fine. Suddenly I'm shouldering the other people's risk, then hey, I'm not as stable as I normally am. So it's a good thing to know, good thing to learn. And now that I'm aware of it, I can compensate for it, and I can make sure that I can behave the way I would have if I was just in it by myself. Now let's take a look over here. What's going? Hey Kirk, good to see you. So SPY, if we take a look at this, it did look like it was going to comfortably go above that EMA 8, but it did not. It closed higher, so it did sort of bounce off of this EMA 20, but it did not print a confirmation bar. All the way until the last 30 minutes, it looked very much like that was going to be a confirmation bar. It was going to be a green bar that closed above the previous day high and above the EMA 8. That would have been a nice bullish sign. It would have gotten me a lot closer towards revising my portfolio scorecard to 2, but we're still at a 1, and we're going to be at a 1 until we print above that EMA 8 and maybe 2 days above the EMA 8 before I'm really comfortable moving to a 2, number 2 bullish. So for now, we're still at that 1. If we break below the EMA 20, I'm probably going to 0. It's just there's not a lot to excite us right now. There's a lot of volatility. VIX is still at 18, and intraday, you're seeing these large ranges, these sudden moves. So it's a little bit difficult, like I've been saying. It's a little bit harder to trade the way that you normally would. The only way to trade in this environment is modify so that you take off your stop losses, you increase ranges of what you're comfortable with, sort of like the city trade where we have a nice comfortable range to the downside. We account for the fact that it might chop back and forth in a certain range. And if it does run in the direction that we think it runs, that we can still capture some profit over there. So we can't set up the strategies the same way that we normally would, or you've got to come up with or shift to completely different types of strategies that thrive in high volatility environments. So we, I'm not too willing to switch to high volatility strategies yet because I don't know that this is going to last. And I don't want to confuse you guys because the high volatility strategies, they're not good for the majority of the time. The majority of the market is not in a 20 plus environment. Even in during COVID, well, during COVID, it definitely was. During COVID, for sure was. But in most of the time, we don't stay above 20 for extended periods of time. So it doesn't, if we're not going to stay in there for an extended period of time, then it doesn't make sense for me to show you stuff that would work in a high volatility environment because a couple weeks later, that information is going to be useless. And your next opportunity to use it is going to be 6 months, 12 months, 18 months down the road, and you'll have forgotten about it again, or you'll be trying to apply it during a time period where it doesn't apply. You shouldn't be using it. So for now, I'm not convinced that I should be sharing high volatility environment strategies yet, and I'm sticking with just modifying our trade structures and spreads to account for the higher volatility. Qualcomm, FTNT, APA earnings beat after the market. Okay, but there's a lot after the market, so I don't know how. What about the rest of them? What about like Hood? And I think was one of them, and several others. So we got to take that on net, which the SPY should do a reasonably good job of taking all of the earnings on net into account. Of course, we're going to miss the ones that are not in the S&P 500, but those tend to be lower cap stocks anyways, and so they wouldn't have a huge effect on what we do. So we can just take a peek at SPY and say, hey, what's it doing after hours? So let's see, maybe this one, this one, this one, this one, nope, this one. So if I go over here to SPY, after hours, it's mostly flat, tiny bit up. So on net earnings, taking earnings into account, it's not having a huge effect. So on net so far, either there hasn't been really big reactions to the earnings so far, or they're going to, or they're balancing each other out. Oh, one thing that we could look at, I was on Roger's VIP room today. I didn't get a chance to say much because he was teaching about time spreads, and I didn't want to interrupt the lesson. So one thing we could do is look at the ones that he gave out today in terms of the time spread. So one was Lucid. So down, but not terribly far down. Seems okay. About 50 cents on, or it's about 2-ish, 2 to 3%, which isn't too bad. And then we've got, am I doing my math right? Let me just make sure because I have still not recovered from all my travels. I'm still a little foggy headed. So down about 50 cents on 17.2. Yeah, 3%. Okay. And then the other one that he showed was Qualcomm. So also down a bit. Let's see, closed around 179, down $3.20. That's nothing. $3.20 divided by 179. Yeah, 1.8%. Okay, so those are probably going to do pretty well, those time spreads. And if you guys don't know what those time spreads were, I'll just I can build them real fast. So there was a calendar call spread on LC Lucid at 17, and they went in at, I think it was 20 cents, he said. So okay. So if we're down by tomorrow morning and Lucid is down to 1670, that's plenty of profit right there. That's 100% profit already. Okay. So that's really good. So Roger has a really nice way of doing these calendar or diagonal spreads. I think he always does calendar spreads, but he takes advantage of the difference in volatility on the close end, on the near end expiration versus the far end expiration because of the volatility crush that happens after earnings. So we're going to get this nice volatility crush, which means this one, the value is going to go much lower, and then the volatility crush on this one is not nearly as big because it was never built into that anyways, because it's after earnings or significantly after earnings versus just a couple days after earnings. And so that's what we're taking advantage of. Of course, there should be a volatility crush here as well. Okay. So if we, and so even so, 50, 60%, 100%, somewhere between 60 and 100% would be a reasonable expectation. So that's pretty cool. And then Qualcomm, they did a 180, and if I remember correctly, it was 98 cents or 95, between 95 cents and $1. So we'll just do buy for $6. That'd be 95 cents. And tomorrow morning, 6:30 a.m. Okay, by tomorrow, 6 at the open, it's trading down to, was it 176? Yeah, 175 and a half. It looks like it might have moved a little bit more. Yeah, still 85% predicted. Even if volatility comes down a little bit, you're still expecting 30-40% overnight. That's really good, a good trade. Okay. So far, there hasn't been huge reactions to earnings. Let's see. Hey, Prebnuts, Steven, or SB, and Kirk, and Ralph, and Stacy. Hood beat EPS estimates and is flat. Yeah, what we're seeing is not amazing reactions to all these companies that are beating. You see, Qualcomm beat as well, and then after post market, it's down. Hood beat earnings and is flat. That's what Stacy's sharing with us. The other day, Palantir beat by quite a bit, 25%. They beat, and even on their revenue, they beat 8.17%. But the market sold off; it went down. So that is a topping type of pattern, type of pattern inside of the markets. If we're getting really amazing earnings and we're not getting positive reactions or we're even getting negative reactions, that means that all those expectations were already built in, and the market's just like, yeah, that's what we thought it was going to be, even though it was way above guidance. Or hey, they beat, great. Now let's take some profits. That is a very topping type of behavior, and that's why I'm very hesitant. It's going to be very difficult for me to get back to a +2 bullish. It's just because there's so many things that we talked about over the last 2 days, plus the fact that we're getting all of these not so great reactions to really good earnings. All of that is this topping type of pattern. And so I do want to continue to be very, very careful. I want to be cognizant to the downside in my portfolios. I want to make sure that I have balanced positions. So if I have 10 slots open, like we've been talking about for the past several weeks, the portfolio management, if I have one bullish position, fine. If there's and I'm allocating 10% to each because I have a small account and I don't really have much choice. If I have a $5,000 account, that's $500. That's the average size of a at the money option. So I don't have a lot of choice. I have to allocate an oversized amount of my portfolio. So if I split it into 10 positions at 10% per position, and I say I don't want to be fully allocated, so most likely I'm going to be at most at this point in time probably 50% cash. If you listened in on the Gamma report this past Monday when Chris and I had JD on, we also talked about the amount of cash allocations we had, and Chris said that he had about 50% cash. I said I had about 70% cash. So if we go on the lower end, we go with Chris's numbers, say 50% cash, then that means I can only fill up 5 of my slots. And if you're like me and you have 70%, then you can only fill up 3 of your slots. So either way, if you just had a one bullish, okay, because we're at a +1 bull and on the market right now, slightly bullish, then if this thing goes to zero because we have a COVID-like event, okay, our portfolio gets dinged 10%. Okay, I still have 90% of my portfolio. That 10% is easily recoverable. Now, if I do it this way, okay, then I have to design my bearish position. It should cover at least one of these in order to hedge out my portfolio. So if there's a COVID-like event, I lose both of these. But on this one, I should gain at least 100%, and that way it would cover one of these, if not more. So that is our goal here. We want to keep it balanced like this so that if there is a sudden drop in the market, then we're kind of balanced out. So if I do this, even if I did this, and I'm not expecting a COVID-like event, well, just say this goes down 50%, and they're perfectly balanced out. These go down 50%. Those should be negatives, but you guys get the idea. Those should be negatives. These should be positives. I'm down 50% on 10% of my portfolio, then I'm only down 5% on my entire portfolio. It's not that bad. Even a big sudden downward rush in the market doesn't really hurt me that badly. So this is why we want to allocate in this way. And also, I've been telling you guys that, hey, I'm planning or I'm trying to plan a service where you guys get to watch me double an account. And while I'm waiting for compliance, I'm going ahead and just doing a visual service for my all access members, and they're getting to watch me, except I'm doing it from 1,500 to starting from $1,500, so a really small account. And that way, there are a lot of different nuances versus a $5,000 account. But in the actual service will be 5,000 to 10,000. It's a little more meaningful for people because if they decide to follow along, at least they're making some money. If they decide to follow along on a 1,500 account, then they're only making $1,500. It's not really that interesting. Well, I mean, it's interesting as an educational exercise, but it's not lucrative. They don't earn that much money at the same time. Okay. So that's why I'm starting with 1,500 or 5,000 on the actual service if it gets approved. Hey, Illinois grain farmer, good to see you. So even though we pulled back to the EMA 20, even though we did bounce off of it, I'm waiting for that confirmation. I'm not super bullish yet or even regular bullish yet. I'm just still slightly bullish, just waiting to see what's going to happen. Gold chopped around, right? So we may be stuck in a sideways pattern for a while, and I would butterfly this, but I don't know which direction to take it. So I would have to do a sideways butterfly that has a really good reward to risk ratio, at least a 3 to 1 plus. Actually, let's see if we can find one. I didn't try to look for one of those. So if I do you could do it as a long call or long put, but if you're expecting it just to be balanced, then you could do an IR butterfly. You can either way, you can express it as all calls or all puts or a mix of calls and mix of puts. It would synthetically end up being the exact same trade. It's just there's different nuances in terms of sometimes there's skews on the puts and sometimes there's skews on the calls. Sometimes you have better liquidity on the puts or the calls. And also over here, what'll happen is if it, no matter what, most likely, unless you go way outside all the strikes, then there's going to be something that's in the money. Okay? And if you go all call or all put, then you'll get more items or more legs or more options that are in or out of the money. So that's only a concern if you get assigned. So normally you would want to consider that or close out your butterfly before expiration in case something needs to be exercised or assigned. So if we go over here and we take a look at gold and see if we can design a butterfly over here, GLD. Okay, and so gold is sort of chopping right around this 366. So probably the best we're going to do is about 365 or 367 and a half. Looks like 365 would be a little bit better. So we'll do, oh, they have $1 strikes. Okay, never mind. Oh, on a 1 day, on an overnight expiration. So let's, we'd want to go at least a couple weeks, 1 to 2 weeks out in order to get a reasonable return. So let's try 2 weeks. 2 weeks would be 19th. It's probably not going to be as liquid as the Friday. So let's just do 21. 21st. 367. If I go 5 wide, which is the default, that is really good. That is almost a 5-to-1 or just about a 5-to-1 reward risk ratio. 425 max profit divided by 75. Okay, 5.6 to 1. That is really good. So we just have to ask ourselves, are we happy with that range, that break-even range? Okay, so the break-even range would be 362.75, 371.25. Okay, and that's pretty tight. I mean, that basically perfectly bounds the action so far, but that's pretty tight. And it might be okay. It might be okay for the reward to risk. It might be if you just say, hey, I'm just going to put $75 in this and see where it ends up in by the 21st and see if it just chops around in this range. Okay, then that would be an easy, very low maintenance trade. If you're willing to just say, okay, if I lose 75, I lose 75, I have a chance of making up to 425, then this is a really nice trade right here. Okay, if you want higher probability, if you don't like that, you want higher probability, then we can move these out a little bit. Looks like these are probably all pretty liquid as well. So I'm going to save this one and put that aside just in case we want to come back to it and just say, well, what if we want a wider range? What if I move this out another 5? So I go 352. That's probably going to be too much, but we'll find out. 382. That's pretty good. It's still a better than 1-to-1 reward risk ratio. It's a 1.5-to-1 actually. 900 versus 600. 1.5-to-1. My break evens are 358 and 376. Okay, so my chances of making money here are significantly better than what, so in other words, my win rate, my win probability is significantly better than the one that we just did. But the the amount that the reward risk is not nearly as good, right? So we have 900, or sorry, 600, right? We could lose $600 over here. This is no longer a just put on the trade and forget about it type of trade, because it's seven before it was $75. Now we're talking about $600, and yeah, we could make $900, but the so if you wanted to make $900 on the other trade, then you just do two lots and risk $150 to potentially make that close to $900. And again, it could just be a kind of, oh, if it makes it, it makes it. If it doesn't, it doesn't. And you don't have a lot of management to do. So I kind of like the other one better. But if you're not good at managing risk, if you get nervous and you don't like to see losses on your ledger, then you would pick the wider one. I'm okay with seeing losses on my ledger. It doesn't bother me. I'm seasoned enough that it's fine. I know it's going to work out for me in the end. But what's really cool is that if we just go, say, 2 weeks in, right? If we go to the 14th, so close of the 14th, or close to close, that doesn't really matter. And I'm not trying to chase the huge profits. Then over here, you can see, oh, this is not that lucrative, 7.5%. But there's a huge range now where I'll be breaking even. Okay, so I can make profit anywhere from 358.82 to 374.83. And that's pretty close. 358, 376. That's pretty close. That's pretty close to the other one. So you don't have to take on a lot of risk. The risk doesn't really come out on until much later in the trade. So if I go out to, say, the Wednesday before, so 2 days before expiration, then what we're looking at over here is, hey, you could make 26%, but that range is still really wide. That break-even range, it's from 359.68 to 374.26. That's still a really wide range. So it's not really until we get to the last 1 or 2 days, and really the last day, where it really starts to squeeze in, where you can make a lot of money. And then, oh, these are credit. Okay, so sorry, let's go back. If we go to the 14th, this is why I don't like credit spreads. Just like, you always, like, everything that you have to think about, you have to recalculate everything yourself. Okay, so my max loss is $75 on this thing. Okay, so that means the capital required that I need in order to go into this trade is only $75. So over here on the 14th, 1 week before the end of the trade, if I'm right smack in the middle, I'm making $32 on that 75. That's basically 50%, not the 7%. It's 7% of the max profit, but it's 50% of your capital. So your return on capital, or your return on risk, is already 50% at this point. That's pretty good. If you could make 50% in a couple weeks, or I guess at this point less than a week and a half, then that's really, really good. And you have this nice, safe, large range in which you're relatively safe, where you're break even. You're at least making a little bit of money in this very, very, very wide range. And then when we get to, say, the Wednesday over here, okay, now you're making, if you're right where we are right now, if the gold doesn't go anywhere, you're making $109 on your $75. That is about 135 or 140% on your risk capital. And that is really, really good. And then, of course, if you hold it to the very end or close to the very end, then with 1 hour remaining right? If you're over here, then you're making a whole bunch of money. So I like this trade quite a bit because I don't think gold is really going to go anywhere for some time. The dollar stopped moving or got, it's not like running through that MA 200. It did give a little bit of a pause when it came close to it today. I don't think there is going to be a lot more action while the government is shut down, or we're waiting for a Supreme Court decision on whether or not Trump's tariffs were considered legal or not. So there is going to be maybe that does happen in that 2.5 week time frame. But Supreme Courts, how long do they take to make their decisions? It's not an instant decision. I think the statistic that I was given for the average Supreme Court decision is over 6 months. So that's a while off. And then the government shutdown thing, well, we weren't too concerned about it. It didn't have any effect when we shut down. It's not going to have a huge effect when it reopens. So I'm not really looking at that. So gold, I think, can chop around for a while. It went on a huge run. Okay, so a period of consolidation, it would make sense. I guess based on what we saw over here, right? It ran up and then it consolidated in this range for several months, for 1, 2, 3, 4, 5, 5.5, 6 months before it ran again. And then now we've been chopping sideways for less than a month. Yeah, less than a month. So 2, 3 weeks. So I like that trade, but only if you're okay with that $75 loss. Okay. And this is not something I would be saying, oh, let me put my normal allocation here. If I have a $5,000 account and I have those, I guess I closed it, those 10% allocation per trade, so $500, I would not be putting $500 on this. I would not do a full allocation here. The reward risk ratio is really, really, really good on my 500 allocation. If I made 100%, then I would make $500. And that's roughly what my max profit hit is over here also. And I'm not going to make 100% on every single position every time, right? I'm going to make probably 50% or 30%. So if we look at 30% of 500, then we're only looking at 300, okay? So one lot, 1 or 2 lots, if I had a $5,000 account, would be appropriate. Okay, so I don't have to risk as much, and I can make a significant amount of money. So I would do, if I had a $5,000 account, I'd be doing 1 or 2 of these. All right. I'm going to save this. I'm going to try to put this in. You know what, I might as well. I don't know if I have. Should I put it in the example account? No, I'll do it during market hours. That way I can record it for the all access people. But I'm going to save this. This is going to be a post-market trade. And I'll remember to see if we can get close to 425 credit tomorrow. Okay, so that's a nice trade. Gold is not really correlated to S&P 500. At least usually it isn't. Let me make sure. It's not really correlated at the moment. But yeah, it's not that correlated. Okay. So and we can formalize that also. Let me get the actual number. I'll do it over the last 30. Might as well do it over the last 20 and 30. 20 trading days would be roughly 1 month. 30 would be a month and a half. I just want to get beyond the volatile period also, just so I can compare. Okay, so over the last 30 days, 30 trading days, negative, basically zero correlation. And over the last 20 days, negative 55. Okay, so not correlate, if anything, opposite correlation. And even 55 is not strong correlation. 65 plus is where I'd start saying that they're reasonably high correlated. So gold, this would sit outside of your portfolio anyways. So if I had the 10 slots, okay, even if it was not a neutral trade, which it is, because we're saying that we think it's going to stay choppy for a while, even if it was just say a bullish trade on gold, okay, I would still give it a 0 score. Okay? Because if there's a huge COVID-like event, I'm not going to expect gold to tank. And in fact, if we look at gold, so excuse me, if we look at the SPY during COVID, it went down like 15% in a couple of days. Okay. So if I go from here to here, 15% in the first week, let's call it. And then at the bottom, it was 35-ish%. So we'll take a look at gold during the same time period. So just February 28th and March 25th. February 28th. It's actually down a little bit. Okay, so down 4%. I should go from the 20th actually. Should go from the 20th. Okay, down 3%. And then by the time we got to March 25th, okay, down 25th, up 0.2%. Okay, so no correlation in that COVID event. No correlation. It did not act as a it did act as a safe haven, as a flight to safety. It didn't really lose much money. It didn't really gain much money during that time period, and so it did act as a safe haven. But it was not a hedge, right? It didn't go opposite. It's not like gold went way up when the stocks went way down, and so it would have balanced out some of your portfolio. It's just that, hey, it was either cash or gold would have done you just fine during that period so that you didn't lose a massive amount of money. So so whenever I do see non-correlated assets, like if I were going to do TLT or silver or a non-correlated, even Bitcoin is actually highly correlated to QQQ and SPY, but if it was any non-correlated asset like gold or bonds, then even if I'm bullish or bearish on them, I give them a 0 score, okay? Because they're not the majority of my portfolio, and they don't move in step or in correlation to the stock market. Okay. And if they were the majority of my portfolio, then I would be giving them ones and minus ones, and then any stock position that I had would be given a 0. So if I was doing a portfolio of bonds and I throw in some stocks in there every once in a while, my stocks would get the 0 score instead of the gold or the TLT. If that makes sense to you guys. Just a little tidbit. I don't think anyone's building a portfolio of commodities or of bonds, but in case you are, that's how you treat non-correlated assets. Okay, let's see what you guys are saying. I've been rambling for a while. Sunita, can we follow along with your trades for a small account and scale for a bigger account size? How much can we scale? What account size? Yeah, so the idea is that I've been teaching you is that the 10 position long short portfolio is appropriate for account sizes up to $1 million and some, or even $10 million. So if you fall within that range, you could just scale it up. Now, you may have some trouble with certain ones with liquidity and the availability of the options, because I'm assuming a $1,500 account. That means that I'm forgetting that I closed it. But what that means is that I'm going to be priced out of a lot of trades. If I'm only trying to allocate $15 or $150 of exposure at a time, there's going to be a lot of trades that are off limits to me, but would be perfectly fine in a $5,000, $10,000, $20,000, $100,000 account. In fact, the bigger your account is, the more trades that you could fit in there. And so you're not going to get that diversity of trades that you might want if you had a larger account. And also the positions that we take, they may not support you. It may not make sense, right? If I do this city trade that we shared, if I do this and I see that there's 240 open interest right here, 930 open interest, 339 open interest over here, that's great. If I'm taking 5 or 10 contracts, 20 contracts, that's perfectly fine. But if your account is so large that when you scale up that you're taking 100 contracts, you probably don't want to do that. Okay? That this single position is not going to support you enough. And you're probably going to move the market if you try to go in and try to do 100 of these at a time. So it does scale, but not perfectly. And of course, the closer your account size is to that 1,500 that I'm doing, then the better it scales, right? So if you only have a $3,000 account, or if you have a $9,000 account, it would scale pretty well. But if you have a $90,000 account, then it's probably not going to scale that well. Okay. Okay. Hi, James. Good to see you. Hey, Jeff. Frank, can you please make your volume louder? Oh, sorry it took me so long to see your comments. Let me see. Microphone. Oh, it's on the max, and I'm speaking, at least I think I'm speaking the same way I normally do. Maybe, does this help? Does that sound better? I am a pretty low talker. I have to admit that, yes. Um, this trade is a credit of 425. That's correct. An iron butterfly is almost always going to be a credit. It's basically always going to be a credit. Yeah. Do you plan on doing something for a larger account? I might, depending on the popularity of the small account. And then if there's a lot of people with larger accounts that want to see me do it, then I can do that as well. But it'll depend on demand. Sounds good. Okay, the sound is good. Would I consider taking a poll in the All Access membership to see what account size to double? You're going to learn a lot more on a small account, right? Because there's so many more things that you have to consider, and that's why I'm doing the small account. Okay? Later on, after I'm complete after I'm done with the small account, after I've doubled a small account, I can consider doing a larger account. Yeah, but there's going to be a lot of things that you just won't care about when you have a larger account, and which means you won't learn nearly as much if you don't. And you want to learn that small account stuff because it'll get your mindset right. Because you should be doing these things on your larger account, but they're not nearly as important, or let me put it a different way. They are still very important, but they're not going to make or break your account if you have a large account. They will absolutely make or break your account on a small account. So it's better to learn on a small account. That's why we always, or at least I always encourage, and Roger always encourages that, hey, when you start out, just one share, one contract, right? That just stick to that, and until you get familiar with what you're doing, then when you want to put that portfolio management aspect into it also, you start with one contract as your base unit, and then you scale up to get to the appropriate allocation size. So, for example, if I want to risk $500, right, then generally that would be one contract or maybe two or three, depending on the size of the contract, right? Then you start putting in that portfolio management aspect into it. But you want to start with that smaller account so you can learn and you can make all your mistakes. You don't want, I'm never going to start out the first time when putting out a service and like double your account and showing people how to double your account. I'm never going to start out with large accounts, never, because that would be doing you a disservice. If you've never had portfolio management before, you don't know what you're doing, then you can get yourself into a lot of trouble. Even if you're following along with me and I know what I'm doing, you don't know what you're doing. And there may be a situation where you miss a video or you miss a session or you miss a trade alert or something like this, and suddenly your portfolio looks different than mine. And you're going to go, what the heck? How do I get myself back in line? Or if you're not in line with my portfolio and my portfolio is well protected, and for that instant that you're not aligned with my portfolio and something happens in the market and you're not protected, then that could get you into a lot of trouble. And so we want those things to happen when you have a small account or when you're trading a small account and not when you're taking a large account. Okay, so the point is, don't be in a rush. And yes, the goal is to double that account. And yes, you would make way more money if you doubled a large account than if you doubled a small account. But the point is, you've never done this before. I promise you, you've never managed a portfolio the way that I'm going to manage a portfolio or teach you how to manage a portfolio before. I promise you've never done it before. Okay. And you're going to make some mistakes. And you want those mistakes to happen on a small account and not on a large account. Right? It's the same way that we train Wall Street people. You're the junior trader, you get a small account, or you get a trade limit size cap, you get capped on your trade size limits until you prove a certain level of competence, and then the training wheels come off. It's the same way. You want to treat your portfolio the same way that you would treat a professional would treat clients' portfolios. You should care about your money. You should care about your money as much as a professional cares about his client's money, right? Because you are the manager on your own accounts. Okay. Yeah, never done it before. Yeah, yeah. So you want to start out small. And then once you've got one under your belt, we can scale up a little bit. You got two under your belt, we'll scale it up some more. We got three, four, five under our belts. Then you can probably maybe do it on your own. You won't need me to guide you anymore. Okay. All right. So let's see. We got into or didn't get into, we looked at a gold butterfly trade, one where the reward risk is so good and the cost to get in is so low that we could say, hey, we don't have to do much management on this. We're just going to hold it to expiration, and either we lose $75 or we lose less than that, or we make a whole bunch of money. So I like that trade, and just remember that's the attitude that I'm going to be adopting if we get executed on this trade. That's the attitude I'm going to be adopting on this particular trade. The allocation is so small that if it goes to zero, doesn't really care. It doesn't really affect the portfolio. But if it wins, it can be a nice contribution to the portfolio. And therefore, this is going to be one that I don't have to manage all that much. So if we go into this trade, or if I get into this trade, and I'll let you guys know that I get into this trade, just know that I'm not going to be updating probably until November 21st or November 7th, or 19th, or a couple days before, or the day of expiration. And shared opinion on what's going on in the markets, the fact that it still does feel like we're at a top, and maybe we're not, but right now, as of all of the conditions that we have right now, it is a very toppy feeling, and something has to change. Something has to change in order for us to get normal bullish again, and especially get very bullish again. So I think that's a pretty good wrap for today. We're pretty close to our normal ending time. So any questions, anything you want me to go over? Been listening while commuting. Happy to, great. Thank you, Sean. Can you send the trade to your email? I cannot do that because if I do that, then legally they will interpret that as a recommendation, which I'm not allowed to do. But I can leave this on the screen for a while until we close. Okay, and this is the gold November 21st expiration, GLD, November 21st expiration, one lot of 362 puts. So buying one lot of 362 put, selling one lot of 367 put, selling one lot of 367 call, buying one lot of 372 call. Okay, so it's 1111. The strikes on the puts are 362 and 367, and the strikes on the calls are 367 and 372. Okay, maybe I can type it in the chat. But I can do things publicly. I can't do things individually, if that makes sense. So I can't email you individually, but I can type publicly inside the chat. Okay, so this is GLD, November 21st expiration, 1 to 1 to 1 to 1. And then we're looking at the threes, plus 1, 362, 362 put, minus 1, 367 put, minus 1, 367 call. I don't like how YouTube doesn't let me put multiple lines in at the same time, but that's what we were working with, 372 call. Okay, plus 1 on 372 call. All right. Couldn't get into that GS trade, and it makes me ask, is it hard to get out of these types of trades as well, unless allowed to expire? So Sean, I addressed that with you and a couple other people as well. It's going to depend on those bid-ask spreads. So we're after markets right now, so the bid-ask spreads are not going to be as accurate, but gold is generally very, very, very tight. So if we go out to November 21st and we're looking at that 362 put, that is a 15 cent, and then 367, that is also 15 cents, and if you're on the call, also 15 cents, and then on the 372, also 15 cents. We got 15 cents all around. Add those all together, that's a 60-cent spread. So you're going to have 30 cents on either side. If you go at the mid, there's 30 cents on either side. So when you trade a butterfly, I always work it. I don't just take the mid. So if it says we can do a 425, and I have 30 cents of room on each side, then that means I could take, the range is 455, 395. So I'm not just going to take 425 credit. I'm going to try to take 435 or 440 credit. And if they don't give it to me, I'm going to work my way down and work my way down, work my way down. It's the same way on your exit. So you got to, so the more sophisticated that you become, you have to stop being a price taker. Okay. So you think you're trading, but you're not. You're just taking prices. You're just going to the grocery store and say, oh, that's $5.99. Okay, here's $5.99. That's what the vast majority of people are doing. We don't call that trading on Wall Street. We call that price taking. You just, oh, okay. Oh, you'll buy it at $6. Okay. Oh, you'll sell it to me for $4. Okay. That's not trading. That's just price taking. Okay. So when we get into these structures that are a lot more lucrative, okay, that are give you way better reward risk scenarios and higher probabilities, which is why professionals go into it. Now you start to become more of a trader, or you could be a price taker still, but you're gonna leave a lot of money on the table or potentially turn winners into losers if you're just a price taker. So you want to work it. So it says 425 credit here. Tomorrow morning, if gold opens completely flat, I'm not going to try to get it for 425 credit. I'm going to try to get it for 440 credit or 430, right? 435, something better than 425. And the worst I'll accept is, well, I might reluctantly try to get 425, and I might, depending on how badly I want to get into this, might accept slightly worse also. I might actually go 420 or 415, depending on how that reward risk ratio looks and that break even looks at that point in time. Okay, so that's a very important and very good point that you brought up, Sean. So you want to learn trading, right? You want to learn trading, not just price taking. And it's a big mindset shift. And that is why when we look at this, when a professional looks at this, we see a market, right? We see a bid and ask. We see people jockeying for the price. We don't see, oh, SPY is at 677.91. That's not what we see, right? But I think what I've learned is that that's the way that most retail traders look at it. Oh, SPY is at 677.9 right now. That's the price. Well, even on SPY, there's a bid ask, right? That is a 10-cent difference between the bid and the ask on SPY, on the underlying, on the equity. Okay, so it's still a market, and there's still a difference. And I'd still rather, if I buy and I sell immediately, I'm going to lose 10 cents if I just take the bid and the ask. Okay, and so a real trader would not just take the bid and the ask. Okay, let's see. Great session. You're very welcome, Maria. So we get 425 credit on that. Okay, I think that was typed in before I made that explanation. So yeah, somewhere around it, right? We're going to try to get better than that if we can. You don't have to. There's no rule 5 to 10% higher than the bid. No, I mean you could literally go at the bid and then slowly work your way down towards the mid. Right? It just depends on how much effort you want to put into it. And I know people who will go in below bid, right, and work their way. They won't get it that often, but every once in a while it hits. Jeff, thank you, Jeff. I did notice market maker moving away from your bidding action or appear to be. Yeah, and a lot of them are computers these days, so it just depends, and that's common also. So if you start somewhere, then the mid shifts, or if you go at the mid still shifts. Okay, so again, that mid price is a false price. It's never a guarantee. So there's no real price until a transaction actually happens, unless you just go in at unless you're a price taker, because these prices are guaranteed by the market maker. Would you change the strikes depending on where gold opens? I could if it opens significantly different, but if it opens significantly different, then I'm probably going to invalidate my trade idea anyways. The idea that this is going to chop. Tristan, good to see you. Gold is the best trade for the upcoming days. I don't know about the best trade. We just looked for a good trade, right? I don't know about best. There's never best. Uh, in trading, I never have this concept of best. I never have this concept of top or this concept of bottom because I'm not going to get the bottom price. I'm not going to get the top price. I'm not going to get the best trade, right? The trade that I pick is not, unless I get super, 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 super lucky, it's not going to be the most profitable trade that I could have taken that day, right? If I say between now and next Friday, I'm going to pick the one stock that moves the highest in those next 7 days or the next 9 days, it's not going to happen, right? No one's going to pick that unless they get lucky. There's no system, there's no reliable way for you to say, okay, I can consistently pick the one that's going to move the absolutely most, or I'm going to get the bottom price, or I'm going to get the top price. There's no way of doing that. So all I'm looking for is good trades, one that returns, that is a good return for my risk, that is worth me putting my money into. Because if I just leave it in cash, I know my cash is going to do nothing, or inflation is going to inflate it away. So I want to look for something that does significantly better than the inflation rate so that I can net grow my money. Okay. So that's the way that we think about it in trading and investing. Got into C fairly easily, but not GS. Yeah, that's just the market maker and the bid ask spread. So if I go to C on the 21st of November, we can see that we've got 15-cent and 12-cent spreads at the money. Okay, and if I go to GS, okay, number one, the dollar price of them is a lot higher. Okay, and so you can see that this is a $2.60 spread. The wider the bid ask is, the harder it is, right? You're going to have to work more. You work harder as a trader, right? Okay, you're very welcome. Very welcome, Maria. Is it best to wait half an hour after the open? I generally do. Yeah, that's a good point, Maria. Learn to work the market maker price in order to better risk reward. Good, Tim. Yeah. Thanks are the XSP bonus trade worked out. Oh, I'm glad you held on to it, John. I'm glad you held on to it and made money. Good. All right, you're very welcome, Sunita. When you scrap for a nickel here and there and a dime there, it adds up to be huge. Yeah, that's right. That's right, Jason. Okay. All right, thanks, guys. Good session today. I'm glad that you guys enjoyed it. Hopefully you're learning a lot still, and I will see you guys tomorrow. All right. Bye, everyone. Have a great day.